Welcome to Griffonomics.
Glad to be diving into this one today.
Yeah, so imagine trying to deploy Google's cutting-edge artificial intelligence, but inside a military warehouse located in, a completely hostile theater.
Right, a place where just using standard Wi-Fi is considered a massive operational security threat.
Exactly, and where data latency could, literally dictate mission failure.
It's a logistical nightmare, honestly.
It really is. So whether you are an institutional investor, a defense sector professional, or just an insanely curious learner, navigating this dense, kind of acronym-heavy world of military contracting can feel intentionally opaque.
Oh, absolutely. It's like reading a foreign language sometimes.
Right. So today we are bypassing all that surface-level jargon. We're conducting a granular investigative report, an inflection analysis, really, on a company called V2X, ticker symbol VVX.
A really fascinating case study right now.
It is. The mission for you on this deep dive is to understand the mechanics behind how a very traditional defense logistics provider is attempting this massive, fundamental transformation into a technology-enabled mission solutions integrator.
And setting the operational baseline here is critical, right? Because V2X occupies a highly specific node in the aerospace and defense supply chain.
Yeah, they aren't Lockheed Martin.
Exactly. They aren't turning wrenches on the assembly line for fifth-generation fighter jets or, assembling hypersonic glide vehicles. V2X provides the sustainment architecture.
The people keeping things running.
Precisely. They are the entity ensuring that those platforms actually remain mission-capable post-delivery. They make sure forward operating bases have resilient power, supply lines, and that the whole global military logistics network doesn't just fracture under pressure.
Right. They manage the sustainment tail, which, historically lacks the premium valuations of the prime manufacturers, but it offers just immense revenue visibility.
Highly predictable revenue.
Yeah. But before we evaluate their pivot into artificial intelligence and smart logistics, we really have to audit their foundational business model.
The bedrock.
Right, the bedrock, generating their roughly $4.4 billion in annual revenue, which is actually heavily concentrated.
It is. So V2X operates as a pure-play government services provider. And the critical metric defining their market position is their contract structure. They operate as the prime contractor for, get this, 94 to 95% of their revenue.
Okay, let's unpack this, because holding prime status at that 95% threshold, that is a structural advantage that fundamentally alters their risk profile.
Oh, completely. They are not subordinated to another major defense firm.
Right. It's like being the general contractor for a massive skyscraper.
Yeah.
You might not pour every ounce of concrete yourself, but you hold the master blueprint, and the client only yells at you if something goes wrong.
That's a great analogy. And if we connect this to the bigger picture, that dominant prime contractor status establishes a massive, incredibly sticky competitive moat.
Because it's so hard to get into that position.
Exactly. Competing at this tier requires a confluence of assets that, frankly, take decades to assemble. We're talking specialized facility clearances, active TSSCI security clearances for thousands of deployed personnel.
But you can't just buy overnight.
Right. Plus, a flawless record of past performance on complex programs and a global footprint that currently spans 349 locations across 49 countries. You just cannot replicate that infrastructure with venture capital.
Definitely not.
And they deliver this high-impact readiness, platform modernization, and supply chain management directly to very concentrated end markets. Breaking it down, roughly 41% of their revenue is U.S. Army.
Wow, okay.
Yeah, 33% from the Navy and 11% from the Air Force.
See, I look at that 85% concentration across just 3 branches of the U.S. military, and I see a distinct vulnerability.
Oh, for sure, there's risk there.
Yeah, when your revenue is that tethered to a single sovereign entity, your forward guidance is basically entirely hostage to the macro defense budget and, whatever legislative gridlock is happening in Washington with continuing resolutions.
The concentration risk, it's undeniable, yeah. They are structurally exposed to budgetary delays. However, the counterweight to that risk is the non-discretionary nature of their work.
Because they keep the lights on.
Exactly. Procurement of, say, new stealth bombers can be delayed by 5 years to save money. But the military cannot simply stop maintaining the aircraft they already have.
Right, or stop feeding deployed troops.
Exactly. The sustainment budget is highly inelastic, which makes V2X deeply entrenched.
And that inelasticity brings us to the primary catalyst that's altering their current trajectory. We need to analyze this strategic inflection point driven by the T6 COMBS milestone.
A huge deal for them.
Yeah, this isn't just a contract win. It's literally a structural revenue baseline for the next
Uh-huh.
decade.
Right, so the T6 COMBS, which stands for Contractor Operated and Maintained Base Supply, it's a massive franchise award. It's a $4.3 billion indefinite delivery, indefinite quantity contract.
That is a staggering number.
It is, and under this framework, V2X takes over the entire supply chain and logistics support for over 700 T6 Texan training aircraft.
Wow.
Yeah, and those are utilized across the Air Force, Navy, and Army. It's essentially the backbone of the DoD's entire pilot training pipeline.
But the timeline on that award definitely warrants some scrutiny. I mean, they won the bid, but then were immediately subjected to a competitor's protest.
Which happens a lot.
Right, but it triggered a stop work order and completely stalled the financial realization of the contract for most of the fiscal year.
True. Competitor protests are basically the standard friction cost of doing business in defense procurement, especially on these multi-billion-dollar single award contracts. But the really critical update here is that V2X survived the scrutiny.
They cleared it.
Yep. The U.S. Court of Federal Claims recently upheld the Air Force's source selection decision, completely dissolving the injunction. So work is resuming immediately, and this single franchise contract is modeled to contribute an incremental $140 million to $160 million in revenue for 2026 alone.
That's massive. But, securing the T6 provides the baseline. The management strategy driving their actual future valuation relies on what they're calling a technology-first pivot.
Moving away from just pushing iron.
Exactly. They're actively trying to migrate the business away from legacy logistics, just moving parts from point A to point B toward becoming a real data-driven integration hub. And the primary vehicles for this are these wild partnerships with Google Public Sector and Amazon Web Services.
It sounds unusual, but the strategic logic of pairing a legacy defense operator with hyperscalers like AWS and Google is rooted in closing a very critical capability gap.
How so?
Well, the Department of Defense desperately wants commercial-grade technology, but commercial tech companies fundamentally struggle to deploy their systems inside classified, disconnected military networks.
Oh, because the integration barrier is just massive. Silicon Valley can build the optimal predictive maintenance algorithm, but if they lack the authority to operate on SIPRNet, the military's classified network, that software is functionally useless to a combatant commander.
Exactly. And that is where V2X comes in. They are positioning themselves as the accredited conduit. They provide the translation layer.
Okay, that makes sense.
So V2X utilizes Google's secure generative AI and machine learning models, and they apply them directly to battlefield decision-making and supply chain visibility. And simultaneously, they're taking AWS's computer vision and robotics architectures and deploying them into military depots to create these automated, predictive smart warehouses.
Right, because V2X holds the security clearances, the facility accreditations, the domain expertise, while Google and AWS provide the scalable compute and algorithmic power.
It's a perfect marriage of capabilities.
We see the strategic logic there, right? Deploying AWS and Google on the ground. But when we audit the fiscal year 2025 balance sheet, that high-tech loss hasn't quite translated into high-tech profit margins yet.
No, it hasn't.
Let's look at the financial realities. They posted record revenue, but the profitability metrics tell a much more constrained story.
Well, the top-line growth was solid. I mean, they generated $4.48 billion in revenue for FY 2025, which is a 4% year-over-year increase, placing them right at the upper threshold of their guidance.
Pretty healthy top line.
Very. And they also delivered a record fourth quarter adjusted EBITDA of $88.7 million. Crucially, they utilized that cash flow to aggressively deleverage.
Paying down the debt.
Right. Over just a 24-month period, V2X reduced their net leverage ratio from 3.2x down to 2.2x by retiring $116 million in net debt.
And retiring debt and refinancing to reduce net interest expense by, $28 million? That's excellent balance sheet management. But here's the structural problem limiting their valuation, the margin ceiling.
The dreaded margin ceiling.
Yeah. Despite pushing toward $4.5 billion in revenue, their adjusted EBITDA margins are anchored at 7.2%. You just don't get valued as a high-tech integrator when you are printing low single-digit margins.
No, you definitely don't.
And the root cause, looking at their portfolio breakdown, is that 61% of their revenue is locked into cost-plus contracts.
Right, and that heavy weighting toward cost-plus and cost-reimbursable contracts defines their whole financial architecture. The government utilizes this structure for sustainment and services because the scope of work is often unpredictable.
So they cover the costs.
Exactly. By covering all allowable incurred costs and then layering a fixed percentage fee on top, the government absorbs the risk of cost overruns. It protects V2X from taking catastrophic losses on complex, open-ended logistics operations.
So a cost-plus contract is basically like hiring a contractor for a kitchen remodel where they show you every single receipt for the wood and nails and then take a fixed 7% management fee on top. You'll never get ripped off, but the contractor's never going to make a surprise windfall, right?
That is exactly how it works. It eliminates the downside risk, but it completely caps the upside. If you engineer a highly efficient, automated way to manage a warehouse using that new AWS tech, you don't get to capture the resulting cost savings as profit.
Oh, wow. So you get punished for being efficient.
In a way, yeah. The government simply reimburses you for the lower operating cost and pays you your fixed 7% management fee on that new, lower baseline. It acts as a structural restrictor plate on margin expansion, keeping them far below the 12 to 15% margins enjoyed by fixed-price hardware manufacturers.
Wow.
So, to execute a multiple expansion on their stock, V2X has to shift its portfolio weighting toward higher-margin, fixed-price contracts. And the only way to win fixed-price work without taking on unacceptable execution risk is to possess proprietary, highly efficient technology, which is where their rapid prototyping initiatives come into play.
Here's where it gets really interesting, because we can see the mechanism they are using to chase those higher margins. We move from the ledger back to the tactical environment.
Out in the field.
Right. V2X is transitioning from merely maintaining systems to engineering adaptive solutions, specifically in the counter-UAS unmanned aerial system space. Let's analyze the Tempest system.
Yeah, the Tempest system perfectly illustrates the DoD's current acquisition priorities. V2X engineers took an existing legacy kinetic effector, the AGM-114 Hellfire missile.
Which is traditionally an air-to-ground weapon on helicopters, right?
Exactly. And they fundamentally re-architected its application. They integrated the missile with advanced radar arrays and proprietary fire control software and mounted it on a highly mobile ground platform.
It is a textbook example of mechanism-based innovation. I mean, it's like taking a sledgehammer originally meant for demolishing walls, attaching a smart sensor to it, and using it to swat highly dangerous robotic flies out of the sky.
That is a very vivid way to put it, but accurate. And what's fascinating here is how this aligns with the Pentagon's urgent demand signal. The traditional defense acquisition cycle, which requires 10 years and billions of dollars in R&D to field a new system.
It's just too slow.
Way too slow. It's obsolete against asymmetric drone threats. The military requires agile integrators who can take disparate existing hardware components, fuse them with commercial data sensors, and deploy a viable countermeasure in months, not decades.
Right. And we see that same accelerated integration model in their training division, too. Partnering with Bell Textron for Flight School Next demonstrates a real move away from legacy, manpower-intensive instruction.
Getting out of the old classrooms.
Yeah. By deploying immersive augmented and virtual reality simulations, they compress the pilot training timeline, reduce the hourly cost of flying physical airframes, and generate higher-margin proprietary training IP.
Right, and these technological insertions are critical for future margin expansion. But to accurately model V2X's forward valuation, we have to look past the current technical capabilities and conduct some backlog forensics. We need to evaluate the velocity of their pipeline.
Absolutely. Looking at their year-end 2025 filings, V2X reported a total backlog of $11.1 billion. And the critical nuance here is that this $11.1 billion figure completely excludes the $4.3 billion T6 franchise award.
Because that won't hit the books until Q1 2026.
Exactly. Therefore, that $11 billion is effectively their absolute baseline floor.
And management is aggressively attempting to scale that baseline. The key leading indicator here is bid velocity, essentially the aggregate volume and value of the proposals they're submitting. In 2025, V2X increased their bid velocity by 50% year over year.
That is a huge jump.
And for 2026, they're targeting an additional 30% increase in proposal submissions.
So the result of that sheer volume is a qualified pipeline that now exceeds a staggering $60 billion.
Yeah.
But I have to apply some friction here.
Sure.
Because a $60 billion pipeline is an impressive top-of-funnel metric, but is not booked revenue.
Yeah.
It just represents the total addressable market of contracts they have identified and are qualified to pursue.
Yeah.
Their actual capture rate, their ability to convert those bids into funded backlog, is what ultimately dictates growth.
Your skepticism regarding the conversion rate is totally warranted. I mean, a pipeline is only as valuable as the win strategy behind it. However, the variable that makes this aggressive bid velocity so potent for V2X is their defensive posture. For 2026, their recompete risk is exceptionally low, sitting at just 3%.
Wow, just 3%. That means 97% of their projected revenue is insulated from competitive bidding this year.
Exactly. They are not burning capital and executive bandwidth, simply trying to defend incumbent contracts from being cannibalized by competitors.
They can just play offense.
Yes, they are deploying their proposal resources almost entirely on offensive capture strategies, pursuing these mega bids from a foundation of absolute revenue security.
That makes a lot of sense.
Yeah, having a 97% secured revenue base allows management to be highly selective. They can target complex, fixed-price integration contracts that offer the margin expansion we discussed earlier, rather than racing to the bottom on low-margin commoditized logistics bids just to keep the lights on.
Okay, so let's synthesize the bull case before we tear it apart a bit. You've got a massive backlog, virtually non-existent recompete risk, highly strategic AI integrations, and a secured T6 baseline.
Sounds great on paper.
Right. If the operational mechanics are this sound, why is Wall Street treating the stock with such aggressive caution? We really need to pivot to the bear case and examine the market skepticism, starting with the capital structure.
Yeah, the primary headwind suppressing V2X's valuation is completely decoupled from their operational performance. It is a structural capital market issue known as the PE overhang.
The private equity problem.
Exactly. Following a corporate merger in 2022, a private equity sponsor, American Industrial Partners, operating via Vertex Aerospace Holdco, retained a dominant 45% ownership stake in the newly formed public entity.
Right. And throughout 2024 and 2025, that private equity sponsor has been relentlessly monetizing their position. Through a series of secondary public offerings, they have liquidated their holdings, driving their ownership down from 45% to approximately 16% by the end of 2025.
A massive sell-off.
Yeah, when a sponsor dumps that massive a block of shares onto the open market, it creates overwhelming technical selling pressure, essentially artificially compressing the stock's multiple, regardless of the fundamental business metrics.
It does. And to counteract this, V2X's board authorized a $100 million share buyback program. They executed approximately $30 million in repurchases concurrently with the sponsor's secondary offerings.
Now, I look at the timing of those buybacks, and I have to ask, wait, if the private equity sponsor is aggressively dumping shares, couldn't this buyback just be a tool to artificially manufacture demand so the sponsor can exit safely, rather than a sign of genuine long-term undervaluation?
This raises an important question, and honestly, it is the exact thesis utilized by skeptical analysts right now.
It just looks a bit convenient.
It does. Transitioning shares from concentrated private equity hands into the broader public float is structurally beneficial for long-term trading liquidity. But the short-term reality is that management utilizing free cash flow to absorb the sponsor's exit limits the capital available for R&D or strategic M&A.
They're spending cash to buy out their old boss, basically.
Pretty much. And because capital is being diverted to buybacks, the market is intensely auditing the quality of V2X's cash generation.
Which transitions us directly to the working capital scrutiny. Despite paying down debt, V2X still carries roughly $1.1 billion in long-term debt obligations. While the 2.2x leverage ratio looks manageable, analysts are pointing out that their recent surge in unlevered free cash flow has been significantly bolstered by negative working capital.
And the mechanics of negative working capital require very careful monitoring. When a company generates cash flow by stretching out their accounts payable, basically delaying payments to their subcontractors or vendors, or by aggressively pulling forward receivables, it creates a temporary cash infusion.
It makes a quarter look great.
It flatters the quarterly free cash flow metric, yes.
But it is a temporary lever. I mean, eventually, those vendors must be paid. If you rely on negative working capital to hit your free cash flow targets while servicing $1.1 billion in long-term debt, you risk a severe liquidity snapback.
Definitely.
It raises valid concerns regarding their ultimate financial flexibility and their buffer against debt covenant limits if, say, a major contract is delayed.
The margin of error is undeniably tight. The strategic outlook from consensus analysts currently rates V2X as a hold or a speculative buy.
That feels fair.
Yeah, the foundation is highly resilient. They possess deeply entrenched government revenue streams that are functionally immune to macroeconomic recessions. They generate highly predictable cash flows, And they offer a pathway to shareholder returns through buybacks once the debt profile is further optimized.
So what does this all mean for you as an evaluator of this stock? It means the upside is currently capped. The fundamental valuation cannot break out until two specific catalysts occur. First, they must transition away from that 7.2% margin ceiling imposed by the cost-plus contract mix.
Right.
And second, the market must fully absorb and clear the remaining 16% private equity overhang. V2X is a complex case study of a legacy logistics provider attempting the difficult evolution into a high-margin technology integrator. It requires real patience to see if the T6 revenues and the AWS partnerships can actually drop to the bottom line.
Which leaves us with a broader strategic dynamic to monitor. As the Department of Defense accelerates the integration of artificial intelligence into both kinetic warfare and global sustainment, the landscape of military procurement is fracturing. The question going forward is whether the successful defense primes of the next decade will resemble the traditional heavy metal aerospace builders of the past, or if they will function more like Silicon Valley software integration hubs wrapped in regulatory camouflage.
Risk defined, portfolio protected.